Warren Buffett says that the best investment you can make is the index fund, and last time I checked, Warren Buffett doesn't own any index funds out there. So is it really the best investment you can make? In this video, I'm going to give you the pros and the cons of putting your money in the index fund. Hi, I'm Giannino. I have a channel where I teach you how to grow money, invest money, and make money. And please subscribe to the channel, like this video, I greatly appreciate it. I personally quit my job about 2 years ago and I trade the stock market full time, and I run this YouTube channel as a business on the side. It's a great fulfilling thing and I love to help people out. So in this video, I'm going to teach you about the 2 pros and the 2 cons of going with the index fund as your investment. And I'm not going to waste any of your time. Let's get into it right now. So one great advantage of investing in the index fund is you have diversification, meaning you own a bunch of stocks with one investment. That's what an index fund does. That's what it allows you to do. So by holding multiple stocks, you have the possibility of not being affected when one stock goes bankrupt or when a couple stocks do bad on their latest earnings report. The only reason investors look towards diversification is because the alternative of stock picking comes with a great risk, because if you pick the wrong stock and you have a third or 50% of your money into it, you could lose, let's say, 50% of your overall portfolio overnight if anything happens. So if you own multiple stocks and you own an index fund which has many stocks, you really cut down that risk where you're not going to lose your whole investment. But I'm not a financial advisor. This isn't financial advice. Let me just give you 2 examples of investments that went straight to zero and everyone believed in them. So Enron back in 2001 was one of the biggest scams in American history, and that stock went straight to zero. 2008, let's fast forward to there. Lehman Brothers also went straight to zero. So if you thought you were a good stock picker and you picked those 2 stocks, you would have lost 100% of your investment. So to get away from that risk and to offer some diversification, people flock towards index funds. And one of the more famous index funds is the SPY. This is the one I'm going to be referring to in most of the video. Let me show you a little bit of what that diversification looks like. This is the SPY 500, meaning they hold 500 different stocks. And this is sorted by the weight. So this is the percentage of what is in. And right now we see Microsoft taking up 4% of the SPY. And as I scroll down, you can just see all the possible companies that you could own just by buying the SPY 500. And as I scroll, you can see there's a ton of great companies. You can also think of diversification in the sense of a basketball team. They have 5 players on the court and a bunch on the bench. If their star player gets injured and the team still does well, that shows you that it's a strong team and they're diversified as a team. So that's all index funds do, is pick the best stocks out there and the best companies. But it should be noted, most of the best investors in the world don't believe in diversification like Warren Buffett and Ray Dalio. They actually believe in stock picking. And something super useful is most of these investors, you can actually see what they're buying. Like this is Warren Buffett's portfolio. You can see he's a big holder in Kraft Heinz and all of these companies below, Delta Airlines, Bank of America. So if you want to know what the best investors are holding, you can always look that up too. But advantage number 2 of investing in an index fund is you can get a dividend if you pick the right index fund. The SPY, the index fund I'm talking about in this video, pays out 1.9% every year. So that's money you're getting paid, that's passive income. You're literally making your money work for you with an index fund that offers diversification. How cool is that? So those are the main 2 advantages of going towards an index fund. Now I'm going to talk about the disadvantages of going into the index fund. Disadvantage number 1 is there's costs associated with it, because people are picking stocks to go in that index fund, and there's always companies associated with these index funds that have expenses. So people need salaries, they have buildings that need to get paid, and they also have tons of expenses topped on that. So if you're buying that index fund or that ETF, you have to pay that company's expenses when you own their index fund or ETF. So the key here is to pick an index fund or an ETF that has a very low expense ratio. All that means is the money you put in, let's say it's $200, a percentage of that is going to go towards the company every year. So you don't want to pick something that has anything above 1. I think the lower you can go under 1, the better off you're going to be. Just for example, the SPY, the index fund I'm talking about, has an expense ratio of 0.9, which is almost 0.1%. It's super small. You don't even notice the amount you're paying every year. But it should be noted some index funds and ETFs have an expense of 2.5% every year, up to 20% per year, meaning you're paying 20% in the market that on average pays 6 to 8% per year. So that means you're paying around 12% per year just to have your money in the stock market, which is supposed to be a place to grow your money, not lose your money. So make sure you're not getting screwed over by bad ETFs or bad index funds. Do your own research and make sure they know what they're talking about and their expense ratio is low. There are plenty of other ways to invest in the SPY 500 while having a low expense ratio. Look at the Schwab S&P 500 index. This has a $2 expense cost for every $10,000 invested. So there's more options out there which could be cheaper. So another disadvantage of going with the index fund is that you're not going to have the same gains as some stocks in the market. Some stocks may outperform the index fund over time. The index fund is seen as the benchmark of the stock market. If it makes 6 to 8% per year, that's the benchmark. If you underperform that, that's considered a bad investment. If you outperform that, that's considered a good investment. Let me give you an example of one stock that outperformed the index in the last 10 years and one stock that underperformed the index in the last 10 years. So we have the index, the SPY, giving us 300% return in the last 10 years. We also have a stock called Amazon. You might have heard of it. You probably buy things from there. That outperformed the index. That had a return of 2,000% to 7,000% depending when you bought in 2009. So that percentage is insane. It makes your 300% look measly. And let me give you one example of a stock that underperformed the index. This is Coca-Cola. In the last 10 years, it gave us 160% return. So Coca-Cola, you can say, underperformed the index in the last 10 years by about 140%. So it would have been better off having the diversification, the dividend, and the returns that were associated with the SPY. Just some reasons why you would pick a stock over the index is because, like I said, if you do your research, 2,000% is a lot more than 300%. And if you understand the company and you do your research enough where you understand financials and their future, you can easily outperform the index by holding for long periods of time and knowing what you're doing. But on the same note, if you think you know what you're doing but you don't put in enough research, you can underperform the market just like Coca-Cola did. And worse yet, if you picked Enron or the Lehman Brothers, you can have your investment go to zero. So that is the one downside of stock picking compared to the index. So that is the index in a nutshell. Let me give you a brief recap of what I talked about. The two advantages of investing in the index contained the dividend. It pays out 1.9% per year for the SPY. Dividends are great. It's free money, passive income. And advantage number 2 was the diversification it offers. You're not subjected to a lot of risk with the index, and one stock breaking down will not tear down your whole account or your whole investment. So the diversification offered is probably one of the single best things the index gives you. And the two disadvantages I talked about today were the fact that if you picked a stock, you could outperform the index over long periods of time by a lot if you pick the right stock at the right time. And disadvantage number 2 is that the index funds and ETFs have expense ratios. This is money you have to pay the company that puts the stocks in the index funds. Some companies will straight take advantage of you and have you pay a ton of money every year just to have your money in their ETF. Some other big points I pointed out was Warren Buffett tells everyone to invest in the index fund. He says it's the greatest investment you can make, yet he does not own any of the index fund. A lot of the best stock pickers out there don't do diversification and they don't buy index funds. They pick their own stocks and they do their own homework. I just want to point that out because if you can put in the time, you will be rewarded for it. And the last thing I want to point out is 2 videos you're going to love. one of them talks about my 4 best investing apps. I think you're gonna love it. Hey, it's Matt coming at you. In this video, I'm going to talk about the 4 best investing apps you can use to put your money in the stock market and the pros and the cons of using each one.